All right. Well, hi everyone. This is the first video in our series of walkthrough videos here for our chapter 0, homework 2. And we're going to start out here, obviously, with exercise number 1. And we're going to continue on, rebooting our accounting knowledge and getting ready to bridge from what you learned previously in accounting classes into what we're going to cover in managerial. Okay, so in our first exercise here, we've got a number of different transactions. And in this problem, what we need to do is just identify the two accounts that are affected in each of these transactions and whether those accounts are going to be increasing or decreasing. With the first one, being completed here for us. So transaction 1 tells us that we received $15,000 of cash from an owner investment. And so in that instance, we have our cash account increasing. We don't need to put numbers in yet, in this section necessarily. But we can identify cash as an increase, and then owners or stockholders' equity as an increase as well. And it might be helpful. I think I'll just put this in so we can all just not number sign there. Just if you're watching this video to provide some illustration in the balancing that's happening here, pretty important to understand the whole concept that we're diving back into. So assets equal liabilities plus equity is the foundational accounting equation. And so in this first problem, I'm just going to put the numbers in. You don't need to do this necessarily. If you're following along, you can just fill out the amounts there. If you'd like to do this, totally fine. But and I'm going to put our equals and our plus sign here just to highlight the whole thing and help you see what's going on. So here we're saying assets, cash is an asset, it's increasing. Equity is increasing because we've put money into the business. And so you can see here, I'll put zeros in just to kind of highlight that as well for your education. So you can see 15,000 on the left side equals 0 plus 15,000. That is true. That is a true balanced equation. And we're good to go. Again, you don't need to put this in yourself. I'm just including this as a reference for you all as I explain the homework solutions here. But again, feel free to follow along, put that in if you want to practice a little Excel formatting and setting up tables and whatnot. Okay, so let's jump into number 2. The company purchases $5,000 of inventory for cash. So now we've got cash again being affected. But in this instance, we're paying cash. We purchase something with cash. So our cash is going to decrease. And on the other side, we're going to have merchandise inventory, spell this right, and that's going to increase. So in this instance, and kind of pay attention to my cursor here because it's going to end up being 0. We're gonna subtract $5,000 of cash, which is an asset, but we're going to add $5,000 inventory, which is an asset. So if we put that through, and you kind of get, it's hard to see the zeros when it's in this format. So I put text format, you can see a little easier. So overall, what happens is the effect on assets as an overall group is nothing. Nothing changes at the overall balance, but the individual types of asset accounts are changing, with cash decreasing and inventory increasing. Again, both of those being asset accounts. And then if we look here, there's nothing, no liabilities, no equity has been affected. So 0 equals 0. That balances, makes sense. Our accounting equation is balancing. So we're good to go. Okay, let's look at number 3. The company purchases $8,000 of inventory on account. So here again, we'll have merchandise inventory. We're getting some of that, and that's going to be an increase, just like it was, in this transaction 2. But in this instance, we have a real specific thing we want to keep an eye out for. When it says on account, that's going to hopefully jog your memory and help you remember that since we bought this inventory, we have the inventory, it's an asset, it's increasing, so we could put that here, 8,000, but we didn't pay cash for it yet. Instead, we basically incurred a liability or an obligation to make a future payment on credit, essentially, if you will. And so we can say accounts payable, that's the liability account we use here. And that is also going to be increasing. So now if we go over to our liabilities side, assets increased, liabilities increased. So now we owe money. We do have the merchandise. Hopefully we can sell it for a profit, make money, eventually, pay this off. That's the whole idea there. And no effect on equity yet because we haven't incurred any revenues or expenses or anything like that, which is really the components of equity that cause it to be affected. And we'll look at that here in the next number 4. So here in number 4, we paid $2,000 for utilities. So again, cash decrease, we're making a payment. So that's going to be a decrease in our assets. And we're paying the utilities expense, and that expense is going to increase. But what that does to equity is decrease it, right? So this E doesn't stand for expense, it stands for equity. And the components of equity include revenues increase equity, expenses decrease it. So there's a little bit of a logic leap you have to make here is that you need to understand that by increasing expenses, you are decreasing equity because the expenses are essentially like a reducing factor to equity. So hopefully that makes sense and you kind of remember how that all works. And that's how it shows up, if we were to look at it from the overall accounting equation perspective. Okay, so the final one says the company pays $3,000 of accounts payable. So again, cash is being paid for stuff. In this instance, we're going to be reducing accounts payable. And so previously, and if we went back up here and we saw, okay, we had $8,000 of accounts payable and we got assets. Now we've got cash decreasing. We're making a payment to reduce our obligation. And so now we have accounts payable again, but this time it's going to be a decrease. Here we can see that our equation still balances. And if these were the only two transactions in this company's history, or didn't know if accounts payable had a zero balance before this transaction, this brought it up to $8,000, and then we made a payment of $3,000, then our residual balance in accounts payable would be $5,000 at this point, right? So liabilities go up. We have an obligation to pay those in the future. We make a payment. Sometimes it's a partial payment, like in this instance, and that balance reduces. And then, going forward, as we sell this inventory, hopefully the alternative would be to burn through the cash that was invested. We don't want that to be the case, long term necessarily. We'd like to be earning cash from making sales, increasing our cash balances that way from customers, and then we pay down those debts and liabilities in the future. So, but you can see here that balances our equation. Put my 0 in just for final touch there. And that brings us to the end of exercise number 1. Hopefully this helps to reboot some of that accounting knowledge. And then in the next few exercises, we're going to start actually looking at journal entries and kind of just taking the transaction accounting, kind of bookkeeping type of work, and that whole methodology and process and practice with that a bit more. So with that said, I will end this video here and I'll see you in the next one to complete exercise number 2. Thanks everyone.